The first modeling company I started was not KCC, it was AIR, and it was a long time ago. But as you can all tell by looking at me, I was a child prodigy and only 10 when I started the industry. And at that time, decades ago, catastrophes were, they might happen once every couple years. You would hear about them, and, Hurricane Andrew, maybe Hurricane Hugo, and they're pretty rare events. And, it was basically up to the insurance industry to kind of handle them. But if we, are you seeing, is that, I'm seeing up there, my slide's not, yeah, perfect, thank you. Fast forward to today, and almost every week it seems like there's a catastrophe somewhere, between a flood or a tornado or a wildfire, of course. So catastrophes have become front page news. And of course, everybody is concerned now and wondering what is going on. And I think if I polled you all, you would certainly all agree that catastrophe losses are increasing, and increasing quite rapidly. And you've probably all seen graphs like this one. This one is just from Swiss Re. There's nothing, special about this graph, except it just shows since 1992, if you look at actual losses, it looks like there is a severe, very significant upward trend. Now, we've already got the climate change discussion started. So if I asked you all what you think the biggest driver is of these increasing losses, how many of you would say climate change? Okay. There are a few, but not a majority. So, okay, so let's dive a little deeper into this. Okay, so before we get to climate change, there are three other factors that are actually more important. One is where we build. Since we've been picking on Florida all day, we'll continue on that theme. And this is, of course, Miami Beach. I have a lot of European colleagues, and what they say is Americans don't like to live near the water. They like to live on the water. Okay? So we build very close in harm's way. The next thing is what we build. 30 years ago, that was a pretty nice house, and that would have been pretty, expensive in relative terms, a house. But that's not what we build today. This is what we build. So the first thing is demographics. The second, which people forget about, is called the wealth effect. Okay, so it's what we're building. More amenities, not a 1.5 bathroom, but a 3 bathroom house. Not a 1 or 2 car garage, but a 3 or 4 car garage. So we're building more expensive properties in harm's way. But the most important reason is the cost to build. If we look at construction costs over the past 20 years, are shown in this graph, almost 20 years, they have increased by it's almost doubled. And if you look where the slope really goes up, that was what time, when was that? Okay, that was COVID. Of course, COVID had a very strong impact on increasing construction costs. So these are the three main drivers to losses. And to prove that to you, I'll show you this chart. Now, what this chart is showing is if we go back to 1900 and we simulate every hurricane that occurred since that time on today's property values, what the insured losses would be. Okay, and these are only insured losses. And you'll see that the y-axis is in hundreds of billions. Now, it's interesting to see these spikes, that you will see that 5 hurricanes would cause over $100 billion in insured losses today. What are they? Some of you may know the Galveston 1900, the Great Miami Hurricane. And in 1926, a Cat 4 made a dead hit on Miami. But of course, in 1926, not many people lived in Miami. Lake Okeechobee, another Southeast Florida event. Fort Lauderdale, another Southeast Florida. And of course, Andrew. Even Hurricane Andrew, if it were to happen today, would cause over $100 billion. So when you look at these hurricane losses, you can see that not only is there no upward trend if you account for exposure changes, but actually we've been lucky. Okay, the U.S. has been lucky. We have not had a Category 4 or 5 hit Southeast Florida, which is the area of highest concentration and almost of property values over, I think, $2 trillion in the Tri-County area in the past several decades. So that's what that looks like. Now, a little insurance lesson. Now, I'm not going to bore you with a lot on insurance, but there's something that every consumer should know, and that is how homeowners premium is calculated. And I don't blame you for not knowing, because insurance is a very complicated product that you get a 100-page policy in fine print that nobody reads. And of course, I've never read my homeowner's policy either. But it's a very important that you understand that your premium is calculated based on a rate, and that's already been talked about earlier today. That's like, what is the risk, say, per $1,000 of exposure? But it's not exactly times, but applied to the cost to repair or to rebuild your home should it be destroyed. That's called the coverage amount. So if you look at the cost indicator, which I already mentioned, you can see even since 2015, again, this about a 70% increase. So if you look at homeowners premium and what part of it the increase is by coverage amount versus rate, you see that the lion's share is the coverage amount. And this is really significant. So before I had a very sad day on Monday. I came to California to start the week to go to the Super Bowl, and I'm a Pats fan, so I started on a pretty low note, but then I flew down to LA, and I also visited the Altadena area and Pacific Palisades area yesterday. And I talked to a couple homeowners who have also become general contractors, and this man was telling me that the cost to rebuild homes in Altadena, not Pacific Palisades, the bare minimum basic was $300 a square foot, going up to $1,000 a square foot. Now that means a 2,000 square foot house is going to cost $2 million to rebuild. That is even higher than this graph shows. This graph ends at about $200 a square foot, something like that. So we are going to be seeing even more increases if that's what's happening with construction costs. So we have a basic supply shortage. There are a lot of economists in here. We have a shortage of labor. It's not really materials so much, it's really a labor shortage that's causing it. I just put this together on a whim. I thought it was interesting because people are all in arms. Homeowners insurance crisis. How many of you heard that there's a crisis, in the homeowners market? I thought this might be interesting using Florida data again. The average homeowners premium in Florida is about $3,700. One car's auto premium in Florida is $2,000. So if you're a typical household with 2 cars, you're paying more for your auto premium than your homeowner's premium. Now, wouldn't you, if just out of the blue someone said, how much are you willing to pay to protect your most important asset? Probably be willing to pay more than for the auto insurance. So insurance is still, given everything that's going on, a pretty good deal. It's not, it's by no means a crisis. Now, a little bit about CAT modeling. I won't go into this in detail because you've heard, I'm surprised, but you've heard so much about the models already. But just to tell you a little bit about our team, we talked, the models build science, engineering, data science. So we have a very impressive team of, PhD level atmospheric scientists, seismologists, structural engineers, earthquake engineers, hydrologists, because we actually cover all types of natural perils, you can see here, and globally. And so our models are used not just by insurers, but also by some banks and ILS investors. So Now, you've also heard already a little bit about what insurance companies use the models for, but just to summarize, the main questions the models answer. How likely are we to have a solvency impairing event? Even the largest insurance companies, State Farm, Allstate, ones that Farmers, they could have each company a multi-billion-dollar loss from one event, which could be solvency impairing. So it was already mentioned earlier today, insurance companies also buy insurance. It's called reinsurance. So they need the models to know how much they need to buy. And I'll get to it in a second, but the reason the models are so powerful is because they give the probabilities of losses of different sizes. How much do we need to cover our expected losses? That's been talked about. We talked a lot about mitigation, which properties are more or less vulnerable, so how much credit or discount I should give to different homeowners for different mitigation devices, and I should say, and commercial property holders, not just homeowners, and stronger building codes. The models incorporate all of that, all vintages, it was mentioned earlier, of building codes by different states. Not only that, but the enforcement of the building codes. Some states have great building codes, but they're not enforced. So the models try to incorporate that as well. And then underwriting, we talked about it. How much business can we write in different geographic areas? Actually, Kara showed this earlier today. The models have 4 different components. Simulate, the first is the event catalog. You simulate millions of events to see, again, what those probabilities are, intensity, vulnerability, and financial. I won't go into that, but I like to show this, which is the main output of a model. It's called the exceedance probability curve, and it shows an insurer how likely they are to have a loss of a different size. Okay, and it was mentioned earlier about scenario analysis, looking at scenarios, and scenarios are interesting, but you can't really make a decision on that. So for example, if I told an insurance company that you could have, a $5 billion loss. Now that's interesting, but if I said, but that's a 1 in 10,000 year probability versus a 1 in 10 year probability, obviously they would react differently. Probably not going to worry about 1 in 10,000, but if it's more frequent, you will do that. So insurers tend to look at the 1 in 100 and the 1 in 250. It's called a PML, probable maximum loss. So, and this is also regulated. So regulators, again, want to make sure that insurance companies remain solvent, because if they don't, your claims are not getting paid. Okay, so you want your insurance company to be insolvent. You want the regulators to look at that. And so about a 1 in 100, 1 in 250, that's normally, where insurance companies are expected to be protected, through their reinsurance or other means. Now, the input to the models are those numbers and replacement values of the properties that are being insured. So again, that's the input to the model, and that can get updated. Okay, climate change. We're now switching gears to climate change. Now, nothing I've said so far means that climate change has not been impacting losses, because it has been impacting losses. This is kind of I call it the cheat sheet here. Okay, this is, I'm sure you've all heard of the Intergovernmental Panel on Climate Change. You all heard of the IPCC, and you know that every 6 years or so, they put out a report that is the global scientific consensus on climate change. And over the past few reports, they've started looking at climate impacts on extreme events. In the early years, this started in 1990, they were just looking at temperature changes and atmospheric changes, but now they talk about extreme events. So here are your extreme events: hurricanes, flooding, wildfires, inland flooding. And this is the current, it's AR6, the current global consensus in terms of frequency and severity. So you can see hurricanes, no change in frequency, increase in severity, wildfires, increase in both. I like the third column here, the confidence. This is very new, which they started putting into AR6. And we've talked earlier about uncertainty. Okay, so even if the confidence is high, there's still uncertainty, but basically it means that the research and the models generally agree. For example, you may be surprised why hurricane frequency is no change. It seems like they're becoming more frequently. frequent, and that's because the models disagree, like they're all over the place. So then the consensus is no change. So the confidence level is high only for hurricanes, flooding, and wildfire. So we'll talk about two of those. If there are any questions later, we can talk about severe convective storms, why that's uncertain, why the confidence is low, but I'll just stick in my talk to hurricanes and wildfires. Okay, so what is the scientific consensus? It is that hurricanes are becoming more intense. Okay, it's probably not a surprise. We know that they have rapid intensification. Somebody mentioned Otis. So we know what the consensus is. We're seeing more Category 3, 4, and 5 hurricanes. So what we need to do as a modeling company is we need to account for that. Someone already said earlier, and I've heard it said before, that the CAT models are backward looking, okay, because they use historical data. We do. We go back to 1900 on hurricanes, which I showed you, fit distributions, extrapolate from that. Obviously, that was acceptable 20, 30 years ago, but not today. So today, we have to what we call climate condition the historical data and then fit our distributions. And we don't use Saffir-Simpson category, we use wind speed, but this is easier to illustrate where what we need to do is we need to adjust those historicals and push more into the higher categories. So we've done that. So this is back to our hurricanes based on today's exposures. And now what I've done is I've added the increase in loss due to climate change. So basically what we've done, we've gone back to 1900, we've made the storms stronger, the VMAX, based on how long it's been since that hurricane. So you'll notice that the earlier orange bars are bigger because we have to add more climate change to get them up to today. And so you see how much that's added. And so if we sum it up, climate change has caused about a 12% increase in AAL from hurricanes to date. Okay, that's up until today. Now, what about the future? Okay, we have to look to the future. Again, we go back to IPCC and we look at their SSPs. You're probably familiar with that, these socioeconomic pathways. And again, there's a high uncertainty here, so we can't just take one number, but this shows for different scenarios, whether we're going to be investing in clean energy and getting to net zero. Those are the first scenarios, the best case scenarios, or down at the other extreme if we're going to keep investing in fossil fuels. So what we do as modelers is we pick three of those, kind of best case, worst case, middle of the road, and extrapolate out the curves, the temperature changes that we'll see based on the IPCC projections. And then, again, we can extrapolate out. This shows like SSP 1, 1.9, 4.5, et cetera. And we can, again, see how those intensities will change. And then again, we can see, this is that EP curve in a different format showing return period losses. So I mentioned the 100-year, the 250-year, very important to insurance companies. And then you can see here the relative changes for those different scenarios. So again, it is significant, but it's manageable. It comes out to about a 1% increase per year just due to climate change, which we need to quantify. But again, it's relatively small relative to increasing construction costs. We're on the order of 5 or 6% per year or even higher today. So they're manageable. Okay, let's go to wildfire. We're here in California. I like pictures, okay? So this picture tells the whole story about wildfire activity. These are the burn scars in the western states by decade, okay, starting in your upper left for the 1980s, then the 1990s. And you can clearly see that wildfire activity is increasing. Okay, now as a modeling company, how are we going to deal with that? Well, with hurricanes, I didn't mention it. We're mainly looking at sea surface temperatures as the driver. With wildfires, there's a variable called vapor pressure deficit. Okay, and that's the difference between the ability of the air to hold moisture and the moisture that's available. So obviously, as the atmosphere becomes drier, the VPD gets greater. And scientists have observed a very high correlation between VPD and wildfire activity. It's more closely correlated to VPD than to precipitation or temperature. Okay, so it's almost like the combination of both. So what we can do, again, as modelers, is we can climate condition our wildfire model to account for this. And basically what you're seeing here is I won't go into too many details, but the wildfire model, we're looking at activity by region, pyromes or ecoregions. And we're looking at the frequency severity distributions, and we're going to, or what we have done is actually condition them to be more conducive or more related to today's climate. And we can do the same thing that we did with hurricane, then we can run all of our losses and we can see what impact climate change has had. So you can see for wildfire, the impact is much more significant. So now we're talking about on the order of 3% per year due to climate change impacts on wildfire activity. So again, you can ask more questions during when we come up for questions, but that's kind of the bottom line for quantification. This just summarizes the catalogs that as modeling companies we produce. Mitigation, okay, we've talked a lot today about mitigated homes and other properties and what kind of mitigation makes sense. We take into account all of that. There was fencing was mentioned, defensible space, the Class A rated roof. What wasn't actually mentioned, but what our engineers observed, and they during the Palisades and Eaton fires, was roof geometry and dormers in particular, and lots of changes gives space for embers to get caught. So actually, roof geometry is actually something we don't mention a lot. You can't really change the roof geometry of your home, I guess, but we might want to think about when we're constructing new homes in California to think about roof geometry. Obviously, the ventilation, the fences, all of these things were already talked about, so we give credit for that. Or a penalty. So for example, we talk about credits, but if you don't have defensible space, if you have a lot of vegetation, if you have a very old roof that's combustible, you can also get a debit. The model has a function called unknown. So the unknown is just kind of an average of what we think homeowners have in a particular area in California. And then from the unknown, you can either be better or worse than that. So these can actually be debits or credits. And then for hurricanes, these are just some of the things. You'll notice that IBHS has a fortified home for hurricane as well as for wildfire. So obviously IBHS fortified gets a lot of credit because that has a lot of combination of these features. So conclusions, so just to kind of wrap it up, I just have one boring word slide to wrap it up. So what we've already talked about, most of the increase in losses is due to exposure growth. That's demographics, wealth effect, construction cost inflation. Something we haven't talked about, and we're not going to talk about it here, but it was really an impact in Florida, was excess litigation. Okay, there was a lot of litigation on the part of attorneys, and a litigated claim, if you get an attorney involved, is going to cost you 5 times more than a non-litigated claim. And some of these were worthy, some of these probably weren't, because a lot of it has gone away. And what people have to realize, like insurance, think of an insurance company like a bank, okay? They take premiums in and they pay claims out, okay? So if you have a very litigious society and claims going out go up, the premiums have to go up. okay? It's just basic economics, okay? Whatever my costs are, my premiums have to cover that. So it's just a very simple law of economics, so just remember that. So if anything's driving it up, the premiums will go up. And there is scientific consensus. We talked about that. We can account for all of this. And then the other point I want to make is that just communication. One of the things the insurance industry is very bad at, it's communicating, okay? They do not, I think, educate or communicate very well. But, I think we do need to think about how we educate the public as well. Not just about mitigation, we talked a lot about that, but how mitigation will impact their premiums, what is really driving their premiums, how we can work on, those issues as well. And then we talked about this. The catastrophe modeling is a standard global technology. And I will say, we do not operate in a vacuum. All the great science that's being done at this university and other universities, all this published work, our scientists and engineers are reading that all of the time. We're IBHS, all of the IBHS research is built into our models. We do joint studies on occasion with universities and collaborate in that. So, all of this stuff that you're doing, I thank you for that, because it's all that you do, and the rest of the academic community is really, really important for us to always build in and improve our models. So thank you very much.